Most traders ignore one of the most powerful signals on the chart, wick rejections. If you understand how candles close at key levels, you can use wick rejections to find better trades and avoid bad ones. In this video, I'll show you guys how to use wick rejections and candlestick closes to confirm your trades much better. So first, we're just going to talk about long wicks and rejections and what these actually mean and what they look like. I have a few examples here on the chart to show you guys because a candlestick has a body and it's really important where the candlestick closes, but wicks can give us a lot more detail about that candlestick and where the market could go afterwards. They show us where rejection is made, especially if there's multiple wicks rejecting a certain area or a key price level, like a support or like a resistance. Wicks basically give you that dynamic. Long wicks at a resistance equals selling pressure, meaning that price got rejected around that level. The candlestick once tried to go higher, but got rejected. That's what a long wick at a resistance would mean. A long wick at a support would mean there was buying pressure, that price got rejected at that level. It's basically like support and resistance. When you have longer wicks facing the top at a key level or at a resistance, it's showing early signs of rejection, potentially before the market reverses the other way. So long upper wicks indicate that the bulls pushed price higher, but the sellers were able to beat the buying pressure and pushed prices down. So it's where you go from buying activity, slowly switching over to that selling activity. Whereas long lower wicks indicate that the bears pushed price down lower, but buyers were able to beat this selling pressure and pushes the price up, creating a reversal, giving you support. So what these wicks really mean in essence is that price tried to go there, it pushed up, it was really bullish, but then came back down and reversed. Price slowly started switching over to selling activity, and then the next candle dropped. So opposite is that price tried to go there. These candlesticks would have been bearish, trying to go down, but you're getting multiple wick rejections. Maybe this was even a key price level, or maybe there was even a key support level here at this price. So when it comes down to wicks, this is the basics of it and some of the basics that you want to understand when it comes to support and resistance wicks. The candlestick close matters more than just the wick, but the wick is also a very, very important part of the candlestick when it comes to rejection. So tips for using wicks properly when it comes to support and resistance. Number one would be look for strong wick rejections at key price levels. That could even be whole numbers. Number two would be trend trading. Use wick rejections to confirm pullback entries. And then number three, avoid fake outs. You're gonna wanna understand wicks so you can avoid fake outs. A wick above a resistance doesn't necessarily mean the market's breaking through. You wanna see a close. And we're gonna talk about all these tips in a few minutes when we go to the chart, and I'm gonna write them down on the screen for you guys and go back to them. Those are just 3 quick tips that we're gonna be kind of covering and going over this video. The third one's important because you could be at a support level or a resistance level, and you might see the market breaking out, but it doesn't close above that level, and it ends up forming a wick and going the other way. So the third tip's gonna be really important in this video. Let's go to the charts so we can understand a little bit more about candlestick closures. So if you come on my streams, if you're part of my inner circle, you'll hear me often talk about candlesticks closing, candlestick closure. That's where we find our rejection. We don't have to enter the market always at every. We can use candlestick closure to identify when the market is ready to turn over. So let's go over the chart. So we're gonna go over the chart here, and we're gonna use a support example for the first one here on gold. So we're on the 4-hour time frame, and I'm gonna zoom in for a minute, and we're talking about long wick rejections in the market. Here's a good area where you can see the market had a support level here. To the left, we have a double bottom and price pushed up. After that, it comes back to that support level where the candlesticks close and where we can see some rejection here. Notice how the market trades here, how it goes below, how it goes below, how it goes below. So this is a tail sign of long wick rejections. Sellers tried to breach the support even with multiple attempts, but it failed. The price recovered and ends up closing above and back in that support. So let me draw this out real quick for you guys. Let's just say we have a support level in the market and the market's coming down to that support level one more time. Maybe the market's been trading way away from there, and a week later, a month later, sometime later, the market comes back to that support. Have you ever taken a trade, you buy the market goes against you, you look a few hours later and you're like, oh man, I should have held that trade. Oh, I got stopped out. That's because a lot of times when the market comes to test a key level, it's gonna wick through it and then come back. Candlesticks are gonna close back above that zone, leaving us a wick in the market. And if I were to draw it out for you, it might look something like this, where we have a candle, maybe something like this. Let's go green and a wick. A candle like this could form at a key price level in the market, indicating that price tried to go down, but it rejected, and now it's closing back above that key price zone. This is what happens here. So think about the market here. If you're buying at support, it's not a bad area to be buying the market, right? But this went down $15 first. So waiting also for these types of things to happen, to see price, like trying to stay out of the market more, so you can give the market enough time to form these types of things, because we're on a 4-hour time frame right now. So you can obviously see this would have been a good area to buy. Why else would this be a good area to buy? Let's tie some things in together here, because we talk about key price levels a lot and candlesticks matter with this. Let's look at what price this is around. 26.25. So if you know, that's a quarter price level, right? That's a key level. There's also a key support to the left. But what does the market do? It wicks down. So at one point, if you were watching this, if you were live on the chart, this candle would have been extremely bearish. If you were watching the chart, this candle here would have been extremely bearish at one point. Looking like, oh my gosh, gold's dropping, gold's dropping. Maybe bringing a lot of sellers into the market thinking that this is going to continue dropping with this bearish pressure that the market's getting. But what happens, it wicks back up. And then it tries again. But how did the bodies close? This is what's important. So like I said, not too long ago, the candle close matters more than the wick, but the wick can help us understand what happened with liquidity. Because if you understand, support is to the left here. So when a wick like this forms, it goes through the support, but it closes back above it. So we still technically form a support here because of the closure, the candlestick closure. I keep saying that word so you guys memorize that terminology. Maybe that's a new word for you guys that are new traders. Trading is like learning a language. There's terminology that you have to learn along the way. So you might hear me repeat words like that for you new traders time and time again. That's what's happening here at this. Let's look at another support example before we go to a resistance example. But the best signals come, guys. So here's a tip again. I'm gonna give you guys a couple more tips in this video. So the best signals really come kind of like this chart right here, when price rejects a level strong with a wick and then closes underneath it or above it like a support or like a resistance. So we're looking at some support examples right now. Look to the right. Here's actually kind of an even better example that might even just be more clear to you guys, because that one, there's a couple multiple wick rejections in there. There's multiple wick rejections there. This next example, which is literally to the right on the chart, we don't have to do much moving to see another wick rejection on the 4-hour here at the same support. So most traders look at support as maybe just obviously horizontal, one line. Support doesn't have to be just a line. I talked about this also in the support and resistance video that I recently made, so you can tie some of those concepts in together. So if we look at this support, look how many times it actually goes underneath that straight line, but it forms wicks. So right here, example number 2 on this video, and then we're gonna go show a resistance level on this chart. So what do we have here? We have a low, aka a support, a key price level. So what does the market do when it comes to that level? It doesn't just fly up. It has a couple reactions, but look at this long wick that pushes price all the way through $10, a little bit over. So imagine you're buying at that level, but then where's your stop loss? I mean, if it wasn't down here at the previous low, you would have got stopped out, right? If it wasn't all the way down here at the most previous low, like below us, you would have got stopped out, right? It would have needed to be 200 pips or a bit over. It would have needed to be over $11, right? Because this wick down $11. Maximum stop loss would have needed to be down here to be kind of safe, because you can see that long wick. This is what the market does. So the market has something called liquidity, right? Liquidity equals volume, volatility, right? And there's a lot of institutions, a lot of big players at hand in the market that drive prices down before going up, aka the wick. That's where you see a lot of these wicks forming. So wicks are key at these types of key price levels, and that's what this main video is about in the Ultimate Candlestick Trading Guide. We're gonna have a whole playlist on this topic. Right now, we're just talking about wick rejections and maybe some things you guys can relate to. Because if you've ever entered a trade at a support and got stopped out, it's maybe a wick forming and then the market goes later on. So you can end up seeing after that wick, market closes above the zone. The candles close above the zone, then forming an engulfing candle. We're not going to talk about the engulfing candle in this video, but there's one right here, a really big one. And notice the price action after that long wick, right? Goes up, pulls back, and you end up going up right afterwards. All right, guys, so now we have an example of a resistance here. You can see gold pushed all the way up to this level. And what did it do? Traded down for a while. The market didn't actually come back for how many days is this? We can even use a tool here on TradingView, date and price range, to measure the date. You can see 17 days later the market comes back. So notice, because the market knows, the market's kind of like a game. Think about it. If there's millions of traders, right, that see the same resistance that we all can see, what are millions of traders going to be doing at that level? Probably selling. So what does the market often do? It plays tricks. It does a quick breakout or fake out. So that's what we're going to talk about. This can help you avoid fake outs waiting for the candlestick to close. Just because you break above a resistance doesn't necessarily mean it's a full breakout yet, until maybe the primary time frame you're using, like a 1 hour or 4 hours, fully closed above there. Because this is oftentimes where you get those wick rejections, because most traders, again, think about it, what I just said, if we can all see the same resistance, what's typically happening at these resistance levels? So think about that concept and then look at gold here, right? So you could see we come back to the level. Does it drop immediately? No. It forms a good wick rejection, $10. So spikes up. Traders might have got stopped out here selling at this resistance, or traders might have been thinking this is a breakout happening, and then it punches down and it forms and holds that level. So those are just little final basic tips on wicks and understanding wick rejections in the market. I'd say wick rejections and candlestick closes truly tell you where price is being controlled. So if you have a better understanding of this, you can time your entries much better, especially for even swing trading. I'll see you guys in the next video. Remember to like, comment, subscribe if you guys enjoyed this video. Peace out, peace out.